$3,947. Not a prediction, not a headline. A mathematical output derived from a formula that the US Treasury has used before. And the last time they ran the sequence, they did it overnight, without warning, without your consent. You clicked because that number doesn't make sense to you yet, which means the mechanism behind it hasn't been shown to you yet. That is not an accident. Most people look at silver and see a commodity, an industrial input, a poor man's substitute for gold when the portfolio needs a little shine. The mainstream narrative tells you silver follows gold, that it spikes during inflation, scares and retreats when the Fed pivots, that it is at its core a minor asset class managed by supply and demand like any other. That is the official story. And the official story is the trap. You see, silver is not being priced as a commodity right now. It is being legally repositioned, quietly, inside the fine print of frameworks that most investors never read and most journalists never reference. The data shows that central banks, sovereign wealth funds, and specific institutional desks began reclassifying hard assets in the period following the G20 Brisbane Summit in 2014, where member nations quietly ratified a framework under which depositor funds could be legally converted into equity during a systemic bank resolution. That framework has a name, Title II of the Dodd-Frank Act. And under that law, the moment your bank enters resolution, you are no longer a depositor. You are an unsecured creditor, which means your savings account is no longer safe. It is collateral. This file uncovers the specific revaluation formula already embedded in monetary history, the legal reclassification mechanism running inside the current debt architecture, and the exact historical precedent proving this sequence has been executed before by the same institution now sitting on $34 trillion in obligations it cannot retire. This is not financial advice. I'm not a licensed advisor. Your capital is your responsibility. Always conduct your own research. Now, let's talk about the clock. Because the number that should be keeping you awake tonight is not 3,947. It is $9 trillion. $9 trillion. That is the volume of US federal debt that must be refinanced. Not eventually, not someday, but by the end of 2025 and into the first quarter of 2026. To understand what that means for your capital, you need to understand what refinancing at scale actually does to a system already running at maximum debt load. In 1940, 51% of US federal debt was backed by gold. There was a physical anchor, a hard constraint on how much the system could expand before the math broke. Today, that number is roughly 3%. 3%, which means 97% of $34 trillion in federal obligations is backed by the promise that someone will buy the next bond, at a rate the Treasury can still afford to service. You see, a debt-based monetary system does not collapse when it runs out of money. It collapses when it runs out of buyers. And right now, the pool of buyers willing to absorb $9 trillion in new issuance at interest rates that won't detonate the federal budget is mathematically insufficient. The Fed knows this, the Treasury knows this, and the data trail suggests that specific contingency frameworks have been stress tested for exactly this scenario. The COMEX vaults are not draining by accident. 20 million ounces of physical silver per month leaving registered storage for 5 consecutive years of supply deficit is not a coincidence of industrial demand. It is a repositioning. Something is being moved off the paper market and into physical custody before a reset event reprices the underlying asset. The breadcrumbs are there. The pattern is recognizable. If this forensic sequence is starting to connect for you, if you are the type of analyst who refuses to be caught inside the official narrative when the mechanism triggers, join the forensic circle. Subscribe. The next autopsy drops without warning. Now. Here is where most people watching this will make the critical error. They will look at the $9 trillion maturity wall, connect it to the vault drainage data, and conclude that a simple supply squeeze is the mechanism driving the $3,947 target. That conclusion is logical. It's also incomplete, because the maturity wall is not the trigger, it is the distraction. The actual mechanism is buried inside a revaluation formula that the US government has already used once in a single executive action that repriced an entire asset class by 75% in less than 30 days. And the legal architecture to run that sequence again is already written. The formula has 4 components. Most analysts find 3 of them. The 4th one is where the $3,947 figure lives, and it is the one they never show you. Start with what the public record does confirm. The United States government holds 261.5 million ounces of gold in its reserves. That number is not disputed. It sits in Fort Knox, in the West Point Depository, in the Federal Reserve Bank of New York. Officially valued on the Treasury's balance sheet at $42.22 per ounce. That is not a typo, $42.22. The statutory price of gold has not been updated since 1973. which means the US government is carrying its entire gold reserve on its books at a price that is roughly 50 times below current market value. You see, that gap is not an oversight. That gap is a loaded mechanism. Here's the math that Crescent Capital and strategist Tavi Costa ran against the current debt architecture. If the United States were to back just 25% of its outstanding federal debt with its existing gold reserves, gold would need to be repriced to approximately $37,000 per ounce. Not speculated, not hoped for, mathematically required. 25% of $34 trillion in obligations, divided by 261.5 million ounces of physical gold, produces that number with arithmetic precision. Now, pause here, because most people watching this will take that figure, $37,000 per ounce of gold, and conclude that this is a gold story. That is the head fake. The actual signal is in what gold repricing does to its monetary twin. In 1980, at the peak of the last inflation cycle, the gold to silver ratio compressed to 19:1, meaning 1 ounce of gold purchased 19 ounces of silver. That ratio is not arbitrary. It reflects the natural geological occurrence rate of silver versus gold in the Earth's crust. It is the ratio that emerges when markets are allowed to price both metals without suppression. Apply that 19:1 ratio to a 51% debt backing scenario, where gold reprices to $75,000 per ounce to cover the majority of federal obligations, and the silver output is not ambiguous. $75,000 divided by 19 equals $3,947 per ounce of silver to the dollar. That is not a projection built on sentiment. That is a ratio-adjusted mathematical output derived from a debt-backing formula the US government has the legal architecture to execute. Which means the $3,947 figure is not a price target. It is a forensic result. But here is where the second layer enters. And this is the layer that changes your position from observer to subject. Most people assume that in a monetary reset event, their brokerage account provides safety, their ETF positions, their allocated fund holdings. They believe that if gold or silver reprices, their paper exposure to those metals reprices with it. The law disagrees. UCC Article 8, the Uniform Commercial Code, specifically the section governing intermediated securities. Context first. Under UCC Article 8, when you purchase a security through a broker, you do not hold that security. You hold an entitlement, a legal claim against your broker's position in a clearing system. The actual asset sits with the Depository Trust and Clearing Corporation, the DTCC, which holds securities in a pooled fungible account. Your name is not on the underlying asset. Your broker's name is not on the underlying asset. Which means in a systemic resolution event, your entitlement is subject to the broker's solvency, the clearing system's integrity, and the legal priority of creditors ahead of you in the resolution queue. Application. Right now, every silver ETF position you hold, every mining equity in your brokerage account, every allocated fund that does not involve direct registered physical title sits inside this intermediated structure. Which means in a 2026 systemic reset, when the revaluation mechanism triggers, the asset reprices, but your entitlement to that repriced asset is filtered through a legal architecture that was specifically designed to protect the institution, not the depositor. You saw the first version of this in Cyprus in 2013. Depositors woke up to find their accounts frozen. A percentage of their holdings was converted into bank equity without their consent. That was not theft under Cypriot law. That was the legal resolution framework executing exactly as written. The G20 Brisbane Summit in 2014 formalized that framework globally. Title II of the Dodd-Frank Act embedded it into US law. The mechanism is not coming. It is already installed. Framing. This is why physical silver, specifically silver held in direct registered personal title outside the intermediated system, is the only hard asset that simultaneously benefits from the revaluation formula and exists outside the legal trap that would capture your paper exposure to that same revaluation. The math produces $3,947. The law determines whether you are positioned to receive that repricing or whether you are the collateral that funds someone else's resolution. That distinction is the entire file. Now, the formula is confirmed, the legal mechanism is confirmed, institutional repositioning in the COMEX vaults is confirmed. But there is still a question the data has not answered yet. Why 2026 specifically? Why not 2024? Why not 2028? The maturity wall explains the pressure, but pressure alone does not set a date. What sets the date is a convergence, a specific alignment of debt cycles, institutional frameworks, and historical pattern repetition that the cycle has produced twice before in modern monetary history. And both times it produced it, A government repriced a hard asset overnight, without warning, and the people holding paper were left holding the liability. If the forensic record we are building here is cutting through the noise for you, if you are tracking these mechanisms as they develop in real time and you do not want to miss the next file when it drops, this is the moment to subscribe. Not because this channel needs the number, because the next autopsy covers the central bank digital currency framework being stress tested in parallel with the 2026 maturity wall, and that file will not wait for you to find it. Subscribe now and stay in the forensic circle. Because Block 3 is where the pattern becomes undeniable. The US is not the first empire to reach this exact coordinate on the debt cycle. Spain reached it, Britain reached it, the Soviet Union reached it, and in every single case, the government did not announce the reset. They executed it. And while the public was watching something else, the historical script is already written. The only remaining variable is whether you are reading it or living it without knowing. Have you ever wondered if history repeats itself? It turns out, when it comes to the rise and fall of great powers, there's a surprisingly predictable pattern. Let's break down the 7-stage cycle of empires and see where the United States might fit in today. It all starts with Stage 1, a new world order. After a major conflict, like a war, a new leader emerges. Think of the United States after World War II. This nation establishes the rules, and its currency, like the US dollar, becomes the world's reserve currency. This brings immense power and privilege. Stage 2 is the peak. The empire is at the height of its power. Its economy is dominant, its military is unmatched, and its culture is influential worldwide. Life is good, and the nation becomes a massive consumer, buying goods from all over the globe. But this leads to Stage 3, overspending. To maintain its global dominance and high standard of living, the empire starts spending more than it earns. It builds up huge debts, both internally and to other countries. The British Empire in the early 20th century is a classic example, spending fortunes to maintain its colonies and global presence. Now we enter Stage 4, the wealth gap. As the empire borrows more, the rich get richer, often through financial assets, while the working class struggles with stagnant wages and rising costs. This creates social tension and political polarization. You can see echoes of this in many developed nations today. This is where things get really dicey. Stage 5, the debt crisis and currency debasement. The government has so much debt that it can't just raise taxes or cut spending enough to pay it back. So what does it do? It prints money, lots of it. Think of the Spanish Empire in the 16th and 17th centuries, flooding the market with silver from the Americas. It seemed like free money, but it caused massive inflation and devalued their currency. When a country prints more money, each dollar, pound, or peso is worth a little less. This is called currency debasement, and it's a hidden tax on everyone who holds that currency. Your savings lose value, and your purchasing power shrinks. This internal weakness leads to Stage 6, the breakdown of order. The economic problems, inflation, debt, and the wealth gap spill over into society. People lose trust in institutions, in their government, and in each other. There can be protests, strikes, and widespread social unrest. The system that once seemed so stable begins to fracture from within. Finally, we reach Stage 7, the rise of a challenger. While the old empire is struggling with its internal problems, a rival power has been quietly growing stronger. This challenger has been saving money, investing in education and infrastructure, and building up its economic and military might. It sees the old empire's weakness as an opportunity. Eventually, the challenger becomes strong enough to contest the old empire's dominance, and the cycle begins all over again with a new world order. So where does the United States stand? We see a dominant currency, high levels of debt, significant money printing, and a widening wealth gap. We also see the rise of powerful economic competitors. History doesn't repeat itself exactly, but the patterns are hard to ignore. Understanding this cycle isn't about predicting doom, it's about being aware of the massive economic forces at play. It helps us understand the world we live in and prepare for the future. What do you think? Where are we in this cycle? Let me know in the comments. Thanks for watching. If you found this interesting, don't forget to like and subscribe for more deep dives into how the world works. History isn't just repeating itself, it's rhyming, with a precision that seems almost impossible. But what if it's not a coincidence? What if the underlying sequence is structural? The data says it is. This means the outcome isn't just a possibility to hedge against, it's a mathematical certainty to position for. So, what's the real question? It's not about whether a reset is coming or when the debt maturity wall will force the issue. The real question, the one most people never think to ask, is this: what specific legal and institutional steps are being taken right now behind the scenes to manage this transition? How are they protecting the system at the direct expense of your unprotected capital? Let's break it down. The revaluation formula isn't some wild theory, it's basic arithmetic. You take 261.5 million ounces of gold, measure it against $34 trillion of obligations, and you get a result. A result that makes $3,947 silver not a prediction, but a simple output. And the legal mechanisms to make this happen, they're already in place. Executive Order 6102 proved the government will secure the asset first, then move the price. UCC Article 8 proved your brokerage account isn't a vault. Dodd-Frank Title II proved your deposit isn't savings, it's collateral. The extraction mechanism is fully installed. The maturity wall sets the clock. The year 2026 isn't a date someone just picked out of a hat. It's the coordinate where the debt cycle, the legal architecture, and historical patterns all converge with mathematical certainty. When this sequence triggers, most people won't have this data. They'll just have the breaking news headline. By then, the repositioning will already be complete. If you're the kind of person who refuses to navigate a rigged system with someone else's map, then subscribe to this channel. This is the Forensic Circle. We don't react to the news cycle. We read the fine print before the news cycle even exists. Our next file will dissect central bank digital currencies and the control mechanisms being stress tested right now, in parallel with that 2026 maturity wall. That report will reframe everything you think you know about financial privacy and capital mobility. Don't miss it. The math is unsustainable. The law is already written. The only question left is whether you'll be collateral or a witness.